So when I first started my dividend investing journey, I made about as many mistakes as you can make. In fact, one of my biggest focuses was the dividend yield. I wanted to go for the highest yield possible. What I realized is that not all the dividend yields that are really high are consistent or stable or safe. And those companies can actually end up going under or stopping their dividend because they just can't afford to keep paying that rate. So recently I've decided to go through all of my positions and narrow it down to the top 40 or 50 positions in my portfolio. I bought a few shares of way too many positions. So I'm consolidating down and I want to buy a lot more shares of fewer positions, but more solid, more secure companies. And this month I'm focusing in on the consumer discretionary sector of my portfolio. I'm going to double down on one position and I'm probably going to sell the rest of my positions in this sector. What's the one position I'm going to double down on this month? You're going to have to stick around to figure that out. Welcome to the channel. My name is Paris Clough and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. And in this video, that's exactly what we're going to do. So I don't know if you know this, but there are 11 sectors in the market. And to be properly diversified, it's usually a good idea to keep yourself in each sector. Have some positions in every sector. Now, a lot of people will say, buy a few individual dividend paying stocks that are really solid and really good, and then go get an ETF to diversify yourself into the other sectors. And that's fine if that's what you want to do. My personal choice was to see if I could get 3 to 5 positions in every sector. And so that means I should probably be anywhere between 30 and 50 positions total. And so I'm pretty excited to narrow it down because I have about 76 positions right now. So now I'm going to share with you my dividend portfolio, my spreadsheets, and the different ways that I track my current dividend portfolio. So this is my OG spreadsheet. This is the spreadsheet that I've used my whole time that I've had. I've upgraded to a few things. I've purchased a few different things. I'll share those with you in a minute. So the first thing I want to share with you is my current holdings in consumer discretionary. So these up here are my current holdings. As you can see, I own 6 positions. This is my watch list right here, the things that I want to look at and buy maybe down the road. But right now I have GPC, HRB, Big 5, Leg & Platt, Honda Motor Company, and Ford. And so now I'm going to share with you the tools that I've used to help me do an analysis and narrow it down to one of these 6 positions. One of these 6 positions is the one I'm going to be doubling down on this month. Which one do you think it is? Put a comment below and let me know which one you think it is so far. So one of the first tools I used was this tool called the Dividend Tracker, and there's a link in the description below, and if you sign up for that you'll get a chance to use the Dividend Tracker as well. If you pay for the year in advance, you get to have access to the dividend portfolio premium features and the Discord channel where we talk about all the different things that are going on in the dividend world. So it's really cool, it's really worth it. Check the link in the description below. This helps me understand a little bit more about each of the positions that I hold, which ones I should keep, which ones I should sell, and or which ones I should kind of watch out for. The next thing I did was I went ahead and I got myself a subscription to Seeking Alpha. Seeking Alpha is a fantastic way to kind of analyze your stocks, analyze your positions, see where they're headed, see where they're going, see what other people are saying about them, see what Seeking Alpha is saying about them. They have this quant over here, it says quant ratings, and this quant rating is really a proprietary service that they have, and it's been pretty accurate in being able to predict good stocks. So let me jump over here to the first one I want to talk about. So Genuine Parts Company, this is one that I own a couple shares of, and this is the Dividend Tracker again. The Dividend Tracker gives you a dividend grade on each one of the positions that you have, or even things on your watch list. So it helps you understand what's really a good position to get into and have that safety and that consistency in your dividend portfolio. So this one has an 84 out of 100, which is a fantastic rating. Genuine Parts, let's see what Seeking Alpha has to say about it. Seeking Alpha says that it's over here it says that the rating summary is a buy, a hold, and a hold. So this has got a great payout ratio of 47%. It's got a 5-year growth rate of 4.76, and it basically comes in as a dividend king with 65 years of dividend growth. So GPC is a fantastic company to have in your portfolio. The next one I want to look at here is H&R Block. So this one has a dividend score of 28, not too fantastic, but H&R Block is a pretty strong company, been around for a long time, so it's probably okay to have in your portfolio. Let's see what Seeking Alpha has to say. So Seeking Alpha has the quant rating over here as a strong buy. Let's take a look at the dividends. It shows here that there's a dividend yield of almost 4%, which is a really good yield. Payout ratio is negative 69%, so that's kind of weird. 5-year growth rate is 4% and a dividend growth of 1 year. So far H&R Block looks like a good buy. Quant rating says it's a strong buy. So that sounds like a really good one to have in your portfolio as well. And the next one I want to look at here is Big Five Sporting Goods. Big Five is one of my favorite places to shop actually for sporting goods. Dividend grade of 74 out of 100, which is really good. Let's take a look and see what Seeking Alpha says. Seeking Alpha says of the 3 people that are doing the ratings, the SA authors strong buy, Wall Street says strong buy, but the Quant says hold, but it's still a 3 out of 5 on the Quant rating, which is still pretty good. Down here in the dividend yield, 6% dividend yield. Are you kidding me? That's awesome. Payout ratio is 18%, which is really healthy, meaning they're only going to pay out of their net profits. They're only putting out, or their gross profits, can't remember, pardon me. 18% of their profits are going into paying back their dividends, and 11% 5-year growth rate. That's a fantastic growth rate, and dividend growth of 2 years. So this is Big Five is definitely one to add to your portfolio and keep in your portfolio if you've got it or have in your portfolio. But is it the one I'm going to keep? Is it the one I'm going to keep in my portfolio for now? Now my goal is to find one that I really like, focus in on it, get to 100 shares, and then I'm going to do some wheel strategy, option strategy stuff, build up my cash flow, and then I'm going to jump into the next position in the consumer discretionary sector. So I'm going to start with one, focus in, build, and then start to expand from there. So which one of these so far? What's your guess? Do you have a guess yet? Put it in the comments below. All right, let's take a look at this next one here. Leggett and Platt, pretty solid company, been around a long time. Dividend grade is 53 out of 100 on the dividend tracker here. Let's take a look at what's over here on Seeking Alpha. They say it's a buy, and a hold. So the quant rating only says a hold. It's a 2.7 out of 5. Dividend's pretty healthy, 4.6 dividend yield. Really healthy dividends, 59, 60% payout ratio, really good. 5-year growth rate is 4%, not too shabby, I guess. Dividend growth is just 1 year, so that's fine. Let's take a look at this next one here. Honda Motor Companies. Now, I have a Honda, love Honda. The car itself is one of my favorite cars to buy. I really like Honda a lot. However, unfortunately, I think that they've just had a recent dividend downgrade. This particular, I think there's a glitch here in the dividend tracker on Honda because it shows a dividend grade of 72, but right now, Honda, I think, just suspended their dividend. So maybe there's just a lag in the data here on the dividend tracker. But over here, it says under Seeking Alpha, it says HMC does not currently pay a dividend. So in a dividend portfolio, you kind of need to have positions that are paying dividends. Otherwise, it doesn't really make sense. Even though I love Hondas, I love the cars, I can't have a non-paying dividend in my dividend portfolio. So this one's kind of an obvious one where I'm going to go with it. So you can narrow it down now to top 5 perhaps. All right, last but not least, let's take a look at this one. Ford Motor Company. Also love Fords. I'm looking to buy a truck here pretty soon, and it's probably going to be a Ford. We'll see. I don't know. I got some more research to do on that, but Ford is really looking good, and it's also looking good in its stocks here. So as a dividend grade 63, for a little while Ford wasn't paying a dividend, and they just came back with a really strong dividend, and they started doing some things with their company to really move that forward so they could start paying a dividend again. And right now their dividend grade is 63, which is a really good grade. 63 out of 100. Let's see what Seeking Alpha says. So Seeking Alpha has it says here the authors, which are basically contributors, people who contribute to Seeking Alpha. They get a chance to rate the different stocks that they like. So that's the SA authors, and they say it's a hold. Wall Street, which is basically the analysts at Wall Street, they say it's a buy. And the quant rating says it's a strong buy. So Ford right now is a strong buy. So have you guessed which one I'm going to double down on this month? I'm going to really sell pretty much all my other positions, and I'm going to just take all that money and I'm going to just buy in, go all in this consumer sector on this one share, on this one position. Have you figured out which one it is yet? I'll tell you, it's Ford. I'm going to go all in on Ford. I'm going to buy because of the quant rating here, strong buy. The dividend yield is pretty good, although the 5-year growth rate isn't that great. It had a really bad downturn during the pandemic, so it's been, it kind of got hit pretty hard, but I believe that it's coming back, and so does Seeking Alpha. And quite honestly, another one of the main reasons why I can do it is because Ford, once you get 100 shares, you can do covered calls on a weekly basis, and you can enhance your investment. You can enhance your cash flow by doing covered calls, and Ford has a weekly option for covered calls on options trading. So that's another reason why I'm doing it. So let's take a look here though and see kind of what's going on with my watch list. So I did a stock screener, and I have a few things that I like to look at when I'm looking at screening a stock to be on my watch list. And one of the things that I look for in a sector is the yield. I want to have a good yield. I don't want to just have a strong company. I want to have a strong company and a good yield. I still have that in me to kind of look at the yield. Also want to look at the payout ratio. I want to make sure they're not paying too much or too little. I want to make sure that they have a good 5-year growth rate. So I'm taking a look at that. And also how many years they have increased their dividends and how many years they've paid their dividends. That consistency in paying dividends is kind of what the whole point of having a dividend portfolio is, because you want to be able to have that consistent income over time. So these are the shares that I looked at. I'm going to be adding MDC, LCII, and ESCA and FRG for sure to my watch list. And of course, Big Five is already going to be on my watch list after I sell, and I'm going to put that back on my watch list. Probably going to be the next position I get into in the consumer discretionary after I've hit my 100 shares of Ford. So that's my goal with consumer discretionary. The next thing I want to share with you is this really cool Twitter account. And this particular Twitter account is awesome because it gives you which shares of which companies are increasing their dividends. And this particular company increased their dividend by 55%. So ticker symbol WINA increased their dividend by 55%. That's the kind of raise you want to have. When you're in a dividend portfolio, when you're building a dividend portfolio and the company increases the dividend, that's literally a pay raise to you. You're getting more money just for holding the same shares. And that's the idea. The idea is over time is that you continue to have that dividend grow and you continue to have the company pay those dividends. So this is a fantastic Twitter account for you to come and take a look at which accounts are increasing their dividends. And every day or every time a share or position or a company increases their dividend, the dividend hike Twitter account is going to have that listed there. So I highly recommend jumping into Twitter and following Dividend Hike if you're into dividend investing. I hope this video was helpful to you to help you learn how to analyze a dividend portfolio and learn how to create a dividend portfolio that's going to be more effective and more productive for what you want to accomplish, which is to have consistent, increasing cash flow through dividend portfolio building. So if you missed the last video I made, you can find it here. Go ahead and subscribe to the channel up here and check out this video up here that YouTube thinks you might like. Thanks for watching. I hope you have a great day, and I look forward to seeing you on the next one.